India just witnessed its biggest ever market manipulation scam. A foreign trading giant, Jane Street, walked away with 36,502 crores in profits, while Indian retail investors collectively lost 1.06 lakh crores. And the shocking part, it all happened in plain sight over 27 months inside India's most liquid derivatives market, the Bank Nifty. But this isn't just a story about one operator or one penalty order. This is about a bucket structure where the Indian retail trader is always the counterparty and almost always the loser. This case is being called India's Harshad Mehta moment for the derivatives market. But the difference is scale and sophistication. Back in the 90s, scams relied on forged receipts and manual settlement delays. In 2025, manipulation happens at millisecond speed using colocation servers, algorithmic trading strategies, and cross-border corporate structures designed to evade detection. What makes this even more damning is the contrast within the US, the home turf of Jane Street. Over there, surveillance systems operate at microsecond level precision. Anomalies like these would have been detected, flagged, and shut down almost instantly. Here in India, it took SEBI 27 months, billions in profits lost, and retail carnage before enforcement finally arrived. In this episode, we break down how Jane Street pulled off India's biggest ever derivative scam and why retail investors bore the brunt, how SEBI responded with a record 4,843 crore penalty, and what India must learn from US market protections to safeguard investor wealth. Because this case isn't just about one firm's manipulation, it's a wake-up call for every Indian investor putting money into a system stacked against them. Chapter 1. How Jane Street pulled off India's biggest market manipulation and hid it for almost 27 months. The Jane Street scandal isn't just the largest market manipulation in India's history, it's also the most sophisticated one yet. Between Jan 23 and March 2025, Jane Street systematically exploited the structural weaknesses in the India's derivatives market, allegedly extracting 36,502 crores in profits, while retail traders, like I said, had the losses of 1.06 lakh crores. This wasn't a simple pump and dump. This was a precision engineered, algorithm driven playbook executed at millisecond speed. To understand how Jane Street did this and got away with it for 27 months, let's break down their strategy and the hidden infrastructure behind it. Step 1. The morning pump, engineering artificial momentum. Each targeted trading day began the same way. Jane Street bought heavily into Bank Nifty components and futures contracts. By deploying thousands of crores into concentrated buying, they created the illusion of genuine bullish strength. This artificially pushed up index levels, sending a clear message to the market that Bank Nifty is breaking out. Retail traders, proprietary desks, and even some domestic funds chased the rally, providing Jane Street with exactly what they wanted, which was liquidity. But behind the scenes, the firm had already built massive bearish options positions, leveraged bets on the exact opposite outcome. Now let's take a case study here of the 17th January 2024. On this single day, Jane Street allegedly bought 4,370 crore worth of stocks in the morning, simultaneously held 32,000 crores in bearish options. By day's end, they netted 735 crores in profit from just one trading session. Step 2. The afternoon crash, the real payout. By afternoon, the tables turned. Jane Street dumped their morning positions, offloading the stocks they had used to engineer the rally. This triggered a sharp, controlled fall in the Bank Nifty prices. Why did this matter so much? Because they were exploiting a critical structural flaw, which is the settlement window. The final 30 minutes of the trading day determined the derivatives pricing. Settlement relies on weighted average pricing during this period. There is no continuous surveillance in these critical minutes. By driving prices down exactly when it mattered the most, Jane Street maximized the profitability of their bearish options positions. Now, this wasn't a one-off trick. This was a playbook that was allegedly repeated across dozens of high-volume sessions, with Jane Street accounting for up to 25% of total Bank Nifty volume on same target days. Now, another big question that arrives here is how were they able to hide this for almost 27 months? The invisible machinery behind the scam, Jane Street didn't just have a strategy, they had an infrastructure advantage that allowed them to stay invisible for over 2 years. Let's break down the 3 key pillars that enabled them to avoid detection. Number 1. Technology advantage, co-location plus millisecond execution. Jane Street used co-location facilities, placed their trading servers physically next to New York Stock Exchange servers, Why does this matter? In high frequency trading, speed is equal to power. Being milliseconds faster allows you to place, cancel, and execute orders before the rest of the market can react. Their algorithms were optimized for market microstructure exploitation, moving prices within precise windows when the settlement calculation mattered the most. In India, where most surveillance is end of day, Jane Street's ability to operate at machine speed created an enormous advantage. Number 2. Regulatory blind spots. The cross-border corporate structure. Jane Street's operations in India ran through a multi-layered structure designed to bypass the close monitoring. JSI Investments handled cash market activity, the buying of stocks. The Singapore-based vehicles handled derivatives trading, which is the real engine of profits. By splitting the strategy across jurisdictions, they exploited information gaps between SEBI's FPI frameworks and local reporting rules. In simple terms, no single regulator saw the full picture. This setup allowed billions of rupees in derivative exposure to build up without triggering red flags, even when individual entities looked compliant in isolation. Number 3. Oversized positions without detection. Perhaps the most shocking detail: on some days, Jane Street's option exposure was 100 times larger than its actual cash positions. In developed markets like the US, such asymmetry would immediately trigger alerts. But in India, SEBI's monitoring systems historically relied on end-of-day position reporting rather than real-time anomaly detection. So as long as Jane Street's booked balance by close, intraday manipulation remained hidden. This allowed them to scale up to 32,000 crore plus derivatives exposure, far beyond what regulators anticipated, without crossing traditional risk limits. The result? An invisible giant in the bank nifty. For 27 months, Jane Street executed this two-phase strategy repeatedly, blending algorithmic speed, jurisdictional loopholes, and timing precision. They became effectively a shadow market maker, influencing bank nifty's price direction while staying below regulatory radars. By the time SEBI pieced it together, the damage was done. 36,502 crore in profits for Jane Street, bank nifty volumes distorted to historic highs. This wasn't market making, this was market manipulation at institutional scale, hidden in plain sight. Chapter 2. The retail investors paid the price. While Jane Street made 36,500 crores, retail traders collectively lost 1.06 lakh crores in FY25 alone, a 41% increase over the year. Why? Because Jane Street's false price signals trapped thousands of traders into losing positions. When the morning pump happened, retail traders piled in late thinking a breakout was coming. By afternoon, the crash wiped them out. Stop losses were hit, leverage positions were blown up, and portfolios eroded. The scam amplified an already bleak reality. 93% of Indian derivatives traders lose money. Jane Street didn't create the ecosystem, but they weaponized it. Chapter 3. SEBI's 4,843 crore response and structural reforms. In July 2025, SEBI announced a record-breaking penalty of 4,843 crores against Jane Street, the largest in the Indian securities history. But SEBI didn't stop there. The regulator launched sweeping reforms to close the gaps which Jane Street exploited. The key reforms that were introduced: number 1 was the increased contract sizes, raised from 5 to 10 lakh to 15 to 20 lakhs to curb speculative activity. Number 2 was the weekly expiry consolidation, limited to one expiry per index to reduce manipulation windows. Third is the real-time positioning monitoring, which is basically replacing outdated end-of-day reporting. Fourth is the upfront premium collection, which is basically to restrict the excessive intraday leverage. Next one is the algo trading oversight, which is about mandatory broker approval, API security, and algorithmic tracking. Next is the AI-powered surveillance systems, enhanced integrated market surveillance system for 24/7 anomaly detection, which is very much needed. These reforms are crucial, but India still lacks global standards, and that is where US comparison comes in. Chapter 4. What India can learn from the US markets. Now, the most shocking part of the Jane Street saga for most people would be the size of the profit that they made, which is 36,000 crores, or the penalty which SEBI has given them. But it's this. Jane Street has headquartered in the US, a market where this strategy wouldn't have survived for more than 2 days. Yes, more than 2 days. Why? Because the US market ecosystem is built on layered surveillance, integrated data systems, and aggressive enforcement. These aren't cosmetic reforms, they are structural defenses designed to protect market integrity and the retail investors. Let's break down the 3 biggest protections that make the difference. Number 1, real-time surveillance. continuous monitoring, not end-of-day snapshots. In India, SEBI's older system relied heavily on end-of-day reporting. This allowed Jane Street to what they wanted to establish. Now, without triggering those alerts, as long as positions are held, looked balanced by the close. In contrast, US regulators operate on real-time transaction monitoring. The SEC's Market Information Data Analytics System, which is MIDAS, processes over 1 billion market records every single day, including order placements, cancellations, and executions, all down to microsecond precision. MIDAS reconstructs the entire order book across exchanges in real time. If a single entity shows abnormally high concentration, cross-market exposures, or patterns inconsistent with organic trading, the system automatically flags it for investigation. This isn't just data collection, it's behavioral detection at scale. Where SEBI needed 27 months to uncover Jane Street's manipulation, MIDAS would have likely detected it at the first spike in the anomalous activity within hours. Number 2, the consolidated audit trail, no room to hide. One of Jane Street's key advantages in India was its fragmented operating structure. It used JSI investments for cash trades, Singapore-based FPIs for derivatives, and routed activity through multiple jurisdictions to exploit in reporting silos. In US, this setup wouldn't have worked because of the consolidated audit trail, arguably the world's most comprehensive surveillance framework. CAT basically tracks every order from origination, routing, modification, execution, cancellation across all exchanges and alternate trading systems. Every order is linked to a unique customer ID. Even if routed through different brokers or multiple jurisdictions, regulators can reconstruct an entire day trading down to each trader's identity, timestamp, and intention in seconds. The level of transparency that they have basically eliminates the blind spots Jane Street could have exploited in India, where FPIs and local entities were monitored separately, allowing positions to build undetected. Number 3, AI-powered exchange monitoring, algorithms versus algorithms. In India, SEBI only recently began deploying AI-driven surveillance tools. In the US, exchanges have been using them for years. Take Nasdaq's Smart Surveillance System, which is an AI-powered monitoring platform used not only in the US, but it's licensed globally. Uses machine learning and pattern recognition to spot manipulation tactics like spoofing, layering, code stuffing, and cross-market collusion. Analyzes billions of data points per day and cross-references them against known manipulation profiles. Generates instant alerts to exchange operator and regulators, cutting investigation timelines from months to minutes. For a Jane Street-style two-stage pump and crash strategies, abnormally large morning positions concentrated in Bank Nifty equivalents, simultaneous opposing derivative exposures 50x to 100x larger the cash trades. Aggressive intraday unwinding time to manipulate settlement prices, where India relied on manual reviews and delayed cross-entity checks, Nasdaq system would have escalated these red flags immediately. Number 4, strict position limits and multi-agency oversight. Even if Jane Street had tried this structurally, the US position limits would have blocked it before it scaled. The CFTC Commodity Futures Trading Commission enforces real-time position limits on derivatives, preventing any single participant from accumulating manipulative scale exposures. Exchanges have built-in circuit breakers for unusual position buildups. Crucially, there is multi-agency coordination. The SEC oversees equities and options, the CFTC handles futures and derivatives, exchanges run independent monitoring, all agencies share data via standardized reporting frameworks. In 2024 alone, the SEC filed 583 enforcement actions, imposing $8.2 billion in penalties. The CFTC pursued 58 manipulation cases, including cross-border collusion and insider-driven block trading. This layered enforcement architecture creates a deterrence effect. Market participants know that if you try something abnormal, you will get caught quickly and punished heavily. Now, why India needs to evolve? SEBI has made progress after the Jane Street scam, upgrading its integrated market surveillance system, introducing AI-powered anomaly detection, and tightening up algo trading regulation, but gaps remain. No consolidated audit trail like CAT, limited real-time cross-market monitoring, and fragmented reporting between FPIs and local brokers. Enforcement remains reactive, not preventive. Until India builds integrated real-time identity-linked surveillance, retail investors were exposed in a system where sophisticated layers exploit milliseconds while regulators work on month-long cycles. This was the end of the video. I hope you find a lot of insightful why US markets is far ahead in terms of evaluating such scams, and are able to detect it before they happen. So subscribe to the channel for more such insightful videos.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.